The last 1 month or so has seen Indian equities gain as investors, both in India and abroad, take heart from the corporate tax rate cut and the government's promise of doing more. That's great news for investors, more so for investors with the large corporates. But the larger question here is whether some of them are once bitten, twice shy, given the sell-off witnessed just before the tide turn, or will that not be the case? Let's ask somebody and the company which manages wealth for the who's who of India Inc., because they would have a good sense of whether the tide of the investors is turning and what it does for their business. Sandeep Jethwani, the managing partner of IIFL Wealth, the country's largest wealth management company, joins us right now on the show. Sandeep, so good having you. Thanks much for joining in. Neeraj here. Good morning.
Thanks, Neeraj.
I dare not ask.
Thank you so much.
I dare not ask you how is it looking, because the Sensex at record highs. The tide in the business, if not turned fully, would surely be showing some tremendous signs of turning. What is it doing to the business?
So, Neeraj, I won't comment too much on the business itself, but to be really honest, I think what happened in the last year was there was a huge risk-off situation that was building up in portfolios. A lot of clients were looking at controlling risk in the portfolios. And you have to look at this in the context of what they are doing in their own businesses. For a lot of clients, the money that they have on the side is often security that they're building outside of their business. So in general, we've seen a very conservative approach that clients want to take in their portfolios, and that is something that's sort of very long term. It's not only to do with what has happened in the last year. What I'm finding very interesting is clients are looking at building systematic processes for their portfolios. They want to allocate money to equities, but they also want to track very, very closely those exposures. From our perspective, we think that clients typically would have 35 to 40% allocation to equities, and the remaining is in various forms of fixed income.
Okay. Just wondering, I mean, without getting into specific numbers or otherwise, Sandeep, but I'm just wondering, what does, and we'll get to the market parlance as well in a bit, but one of the reasons why I wanted to have these conversations with you was that when we look at what the allied asset management linked business stocks have done, the market seems to be believing that the tide has turned for the better, and it will show in the way the businesses of some of these companies like yours, for example, will do as well. And when I look at, when I try to understand the business, you yourself are trying to, in a meaningful way, try and increase the size of the recurring business versus the non-recurring business as well. Tell us, if indeed the market shape and size stays well, do you think it works beautifully for the earnings of IIFL Wealth, the listed entity?
So, Neeraj, like you rightly said, we are focusing very hard on the annualized recurring revenue business. And over time, obviously, as the assets under management grow, the annualized recurring revenue can only grow from here. What's also important is because these annualized recurring revenues are a percentage of the assets, so the assets under management grow, and they can grow by net new inflows, but they can also grow by valuation increases that happen in the portfolios. It has a sort of positive effect on the overall business. So to answer your question, yes, I think if the market tide does turn and there is a consistent up move that we see in the next few years, it is extremely positive for the business. The other thing that is also important is that, to some extent, there is a lot of flow that we are also beginning to see in alternative assets. And that is not only in India, but also globally, where clients are allocating money to alternative assets, which also help us sort of manage retentions very well, especially on our asset management side. It's a very, very positive effect.
I believe you're trying to position the AMC and the mutual fund business in that fashion, right? I mean, getting in Anup was one thing, but even the positioning, it's not centered around locally managed funds the way everybody else is doing, but with a bit of a difference. One, tell us about it, and two, how is the reception that such an offering is getting from clients both abroad and maybe in India?
So the alternatives business, we think, is set to grow in a very big way. What is happening is there are pockets of opportunity arising especially in the last year in alternative assets. We have had a very, very successful pre-IPO fund, which we call Special Opportunities, which done exceptionally well. We're also looking at building up the structured lending business. And here again, because of what happened in the last year in terms of the NBFC crisis and the risk aversion that lenders saw, we are getting extremely good opportunities to deploy capital in structured lending transactions. We've raised a fund which is now nearly about 1100 crores focused around this opportunity. And the advantage of that, obviously, for our clients is they're able to take exposure to instruments which otherwise were not easily available to HNI investors. In the context of the business, therefore, obviously, it's a big positive. From a client allocation perspectives, the allocation to alternatives is only increasing. From a global perspective also, a lot of global investors are looking at taking exposures to Indian alternates, and from that perspective, we are extremely well positioned.
How would this turn from in trying to increase or trying to change what the large portion of your business is currently to what it would be? What would that whole shift entail? Would it also mean a bit of a change in the ethos of the business, a change in expenses because you have to market the other position part a lot more? Because frankly speaking, it's a lot smaller compared to the existing business that you have and comparable to the others as well. How would those next 12-24 months shape up then?
So, Neeraj, for us, actually, if you go back in 2008 when we set up the business, the ethos was pretty much consistent throughout, which was the fact that we will build a process-oriented approach to our portfolios that we manage. And in a sense, the annualized recurring revenue model aligns very well with the process-oriented approach. Now, within the ARR assets, as we call it, there are two parts. One is which are broker distributor, or where clients are allowing us to earn commissions. But also what is increasingly becoming more important is the allocation of money that is going to our fee-based business, which is what we call IFL1. And there again, the interesting part has been that I'm extremely positively surprised by the client's reception to that. In fact, a large part of the net new assets are moving towards the IFL1 business model. Over time, we are also seeing client assets of existing clients also move to this model. From our perspective, what we have done is, while a lot of client engagement is important, we've also done a lot of internal engagement in the course of the last year. We launched this actually in October of last year, so we finished approximately a year of managing IFL1 assets. And within this also, there has largely been two parts of sort of the engagement a client would have with us. The first part is where we have what we call a discretionary engagement, where the client gives us a mandate and our centralized team manages the portfolio. And the secondly is a non-discretionary mandate. Interestingly, what we're seeing, the discretionary mandates are actually increasing in size. Larger clients seem to be opting for it, and it's understandable from their perspective that on a day-to-day basis, they don't want to be involved in the portfolio. What it means for us, therefore, is obviously significant productivity gains in that we are not spending too much time on individual transactions with every client, but largely focusing on the goal-based approach where we are sitting down with the client, understanding his objectives, and then designing a portfolio that meets his. And then that portfolio is managed by a centralized team. So yes, from a productivity standpoint, and to that extent from a cost perspective also, it's a very big positive. So in a sense, all of this sort of beginning to align with each other, where from a client perspective, we are getting annualized recurring revenues, but also from an internal perspective, we are seeing significant productivity benefits coming out of this.
Great long term. Does it have some repercussions short term, which might well be priced in? I'm not saying no, but does it have some short term earning repercussions?
So, the recognition of revenue, the moment that changes, obviously there might be short-term repercussions, and that has already been guided and by the management. So in that sense, that's already factored in to some extent. But a large part of our business continues to move to the annualized recurring revenue. In fact, the rate of growth, the annualized recurring revenue, I think over the long term will be extremely beneficial for the firm. And in a way also that from a client perspective, and which is actually the most important thing for us, it aligns us extremely positively with them.
Okay. What about the feedback that you might be getting from investors, both local and global, about this uptick in Indian markets post the corporate tax cut, Sandeep? I'm just shifting tracks a bit and trying to get a sense of whether you believe this momentum shift that we've seen is sustainable, because there are two things that have happened, right? One, that the market now seems to believe that the government's interests are aligned with the market's interests as well, healthy. And two, there's a bit of a risk on by virtue of the non-performing companies or non-performing stocks starting to perform as well, where most of the portfolios are hiding. What's the feedback that you get?
So what's interesting is that obviously Indian allocations will only increase from where they were for the last few quarters, and even from local investors the allocation to equities is likely to only go up. What, however, continues to be a trend is that people are still focused on good quality. When I say good quality, within every space, whether it is the large cap or the mid cap, there is a focus towards looking at companies with good corporate governance, companies with steady business lines, which have sort of will be able to see through any short-term issues. So from that perspective, yes, there is an renewed interest back in India. But at the same time, there is a sort of a cautious approach that most investors are taking, where they're looking at companies which they believe will be able to ride through any near-term issues. So Indian allocations, I think, I'm extremely positive. So in fact, if you speak to even domestic investors, for the first time there is a recognition that the government is fully invested in getting the economy back on track. The corporate tax cut is extremely positive. We are seeing the benefits of that even in our clients, where most of them being entrepreneurs are extremely enthused by that. And I hope that as the economic cycle begins to turn, if it does, some of that monies will go back into capex sooner.
Okay, just one more question on that, and particularly from a perspective of what large global players might be telling you, whether they are clients or whether they are people that you prospectively meet. I think 3 months ago, or 2 months ago, maybe the narrative was that with the Kashmir issue, with the government maybe not seemingly fully invested then, so on and so forth, the monies might take some time coming in. We've seen FII flows come back. I don't think it's a big deluge, because a lot of it is also due to bulk deals. So if you discount for that, it's not really large scale money the way it's gone into China. Do you sense that people will be a lot more amenable, global funds might be a lot more amenable to put money into India now?
See, Neeraj, I think, as you know, the optics are very important. So I think for the last few months, whatever the government has done, the optics seem to have changed, and it seems to be aligned with the fact that the government is here to support the economy, that they will take steps as and when necessary to step in and try and help out. So from that perspective, I think flows will return whenever you see a little bit of an earnings uptick. I think the flows will return very strongly, and I agree with you. Even right now, the flows are not very broad-based. You're seeing very selective buying in individual stocks and sectors. So I think, but at the same time, as soon as you see a little bit of a broader earnings recovery, the FI interest will return very fast.
Okay. Just one final question on this conversation, Sandeep, and that is with regards to what is primarily believed to be your strength. Maybe you have other strengths too, but the fact that you have the pulse of the ultra high net worth Indian investor, what is that investor doing? Is he becoming risk on? You mentioned briefly that they are still looking at companies which will tide over the current crisis as well. But is he starting to put money into pockets where there might be some risk associated, equities, non-equities, otherwise?
So, Neeraj, at the broader theme, one of the bigger themes that we've seen over the last few years is actually a theme of financialization, where in their own portfolios, most HNIs are now allocating higher amount of capital to sort of financial liquid assets, which in itself means that lesser money has gone towards physical real estate. The second thing within the financial assets is obviously there was a risk of trade that had happened for the last few quarters, and I think that seems to have turned a bit. People are looking at, or at least asking questions around monies to be allocated to equity assets, and that's extremely positive. I think where I wouldn't call it a risk on yet, but people are definitely looking to allocate money to growth oriented part of the portfolio. And third is still the approach of controlling for risk is very, very important. So I think that they are continuing to persist with, especially given the context of what happened in the last year. So for most clients, I think while there is sort of small steps being taken to increase growth assets in the portfolio, there is a approach to manage and control risk in terms of allocating to a single instrument, to a single security. So from that perspective, I think it's a bit of both at this point, and I think people are still largely on the fence, but with a positive orientation at this point.
Okay. Sandeep, great having you. Thanks much for taking the time out and speaking to us today at Bloomberg Quint.
Thank you, Neeraj. It was a pleasure talking to you. Thank you so much.